Hello and welcome to the Female Property Expert podcast. This is where we dive into the exciting world of property investment. I'm your host, Emma Morby, and today we're going to explore some crucial property-based facts that every inspiring investor should already know. Understanding these facts is essential to you, succeeding in the property market, as well as continuing to grow your portfolio. Whether you're actually a newbie or you're looking to expand your knowledge in different sectors, this episode is packed with valuable insights to guide you through your property investment journey. So let's dive in. Investing in property can be a fantastic way to build wealth. Everyone knows that. But it's essential to be well informed. Today, I'll share key facts about property investments and explain why they are so important and why corners shouldn't really be cut. The first one you've probably heard me refer to a lot: location, location, location. So this is perhaps the most crucial fact in property investing, as it's important to pick the correct location. And I'm sure you've heard many a time phrases like location, location, location. But I want to break down why it matters so much. Firstly, you have property value. The location of a property significantly influences its value. Properties in prime locations tend to appreciate faster and hold their value better during market downturns. Then you have rental demand. A good location attracts tenants. Proximity to amenities, schools, public transport, employment hubs, universities. These can increase rental demand, ensuring that you get a steady rental income with very limited void periods. And then you have future growth. So researching future development plans or infrastructure projects can help you identify areas with potential for vast growth. Investing in such locations early can yield significant returns on your portfolio or your property, which may be only 2 to 4 years old and double in value, for instance. Now, when looking for investment properties, it's always important that you prioritize location. Use tools like Rightmove, Zoopla, and even local council websites to gather information about that area, especially if you're not familiar with it. Fact number 2, property type matters, okay? The type of property you invest in can make a massive impact on your returns and overall investment strategy. Let's take residential versus commercial. Residential properties are generally easier to manage and finance, making them ideal for beginners. Commercial properties can offer higher yields, but come with more complexities and higher risk. Then you'll have new builds versus older properties. Now, new builds often come with modern amenities, kind of fewer maintenance issues, assuming they've been built correctly. But often they are more expensive to buy. Older properties might offer better value with the potential for renovation, but they require more upkeep and more upfront investment cost. And then you've got single family homes versus multi-unit properties, or things like HMOs. Now, single family homes, pretty straightforward, but often they'll yield slightly lower in returns. Whereas multi-unit properties, these could be duplexes, apartment buildings, HMOs, serviced accommodation, they can often have higher rental income but require a lot more management and your time. So when looking at what type of property you're going to go for, you need to look at all aspects: your time, new versus old, residential or commercial, whether you want it to be a single buy-to-let or whether you want to earn a little bit more money and have it as an HMO. And then, of course, based on that, you then choose the location. Understanding the pros and cons of different property types will help you align your kind of investment with your financial goals and also your risk tolerance. Fact number 3, the importance of cash flow. And I can't harp on about this enough. Cash flow is the lifeblood of a property investment. It's the net income you earn from your property after all expenses have been deducted. So let's start with positive cash flow. Always aim for positive cash flow. This means your rental income exceeds your expenses, providing you with a steady income stream and financial cushion. If you have very little margin between the amount of your expenses and the actual profit you make, this is not a good investment. Expense management. So accurately account all expenses, including mortgage payments, property management fees, maintenance, insurance, tax, anything that you need to buy for that particular property, perhaps white goods, repair a fence. You need to make sure you accurately account for all of this. Unexpected expenses can quickly turn a profit into a loss-making property. And you need to buffer for vacancies. So factor in potential vacancies to ensure that you buffered to cover periods without rental income. Traditionally, most buy-to-let properties will go through 2 months every 12 months of no rental income if you have a reasonably high turnover of tenant. A good rule of thumb is to have at least 3 months worth of expenses saved up. Keeping a close eye on your cash flow ensures your investments remain profitable and, more importantly, sustainable over a longer period of time. Fact 4, leveraging and financing. So leveraging or using borrowed capital to finance your investment, such as mortgages or private investment, it is a very powerful tool in property investing. However, it does come with some very big risks. Let's take mortgage options. Understand the different types of mortgages available. This will include flexi rate, variable rate, interest only. Choose the one that aligns with your investment strategy and your risk tolerance. Don't over leverage yourself. Then you have LTV or loan to value ratio. So the loan to value ratio represents the amount of the loan compared to the property's value. A lower LTV means less risk and better financial terms. Aim for an LTV ratio that balances leverage and safety. Don't opt to take the maximum amount of money that you can out of that property if you don't need to, because it leaves buffering for you should anything go wrong. And in this section, I've also included debt management. So avoid over leveraging. And I stress this to people so many times. High levels of debt can lead to like a financial strain if the property values fall or the rental income decreases for any reason. So you always have to ensure that you have a comfortable that you are comfortable to service your own debt on these properties. Now, I'm not saying you're going to have to fork out the money from your pocket. But if you already buy a property that is not performing and it's already not making the cash flow you need in profit every month, then you have to ask yourself, what is the benefit of having that property? Leveraging can amplify your returns, but it also massively increases your risk. Use it wisely and always have a plan to manage your debt if for any reason you have long void periods or the property value goes down. Fact 5, market cycles. You probably have heard me talk about this many times. The property market has a cycle. There's periods of growth, stability, and then decline. Understanding these cycles can help you make informed investment decisions. This is one of the things we teach really early on in our Property Unwrapped program, because you need to recognize where in the property cycle you're coming in at. So, boom and bust. The market goes through the cycles of boom, which is like a rapid increase in price, and then bust, which is where the price declines. Recognizing these cycles help you buy low and sell high. Then you can have economic indicators. So keep an eye on economic indicators like interest rates, employment rates, and GDP growth. These factors influence the property market trends. And then the long-term perspective. Property investment is typically a long-term strategy. Don't panic during market downturns. Instead, focus on the long-term potential of that investment. How much will it increase over a 10 to 15-year period? How much will your rental increase over a 10 to 15-year period? Being aware of the market cycles and the economic indicators, it allows you to time your investments better and avoid panic selling during downturns because you bought at the wrong time. Fact 6 is property management. So effectively, property management is crucial for maintaining your property's value and also ensuring it has a steady rental income. Now, there are two types, self-managed versus professionally managed. Decide whether to manage your properties yourself or to hire a property professional. Now, self-management saves money, of course, but it requires a fair amount of your time and effort. Professional management offers convenience and expertise, but more importantly, it doesn't give you a direct link to your tenant. So they can't ring you at 3 o'clock in the morning to say they've been locked out and you have to let them in. Tenant screening. So thoroughly screen tenants to ensure that they are reliable and they can afford the rent. Good tenants reduce the risk of late payments, of property damage, of non-payment full stop. So tenant screening is quite important when you're looking at finding the right tenant who's going to stay in your property for as long as possible. And finally, regular maintenance. So regular maintenance keeps your property in good condition and tends to prevent costly repairs. If you address issues promptly, this will also keep your tenant happy, but it protects your investment. If there's a leak and you choose to do nothing with it, then you're going to have a lot more expenditure fixing that leak 6 months down the line than if you'd done it when the tenant alerted you to it within week 2. Good property management practices enhance your property's value and ensure kind of a smooth investment experience for you. So property investing can be incredibly rewarding, but it is essential to approach it with the knowledge and caution. By understanding these crucial facts like location, property type, cash flow, leverage, market cycles, property management, legal environment, which I didn't touch on today, you can make well-equipped, informed decisions and avoid what we call the common pitfalls that I see a number of early investors making. Thank you for joining me today on the Female Property Expert podcast. I hope you found this episode informative and helpful. If you have any questions or topics you'd like me to cover in future episodes, feel free to reach out. Until next time, happy investing and stay informed.